First and foremost, thank you guys for joining. I'm going to kind of talk about Connect Invest, who we are, where we came from, and then Chris is going to take it away with how our short notes can be a benefit to you in your investment portfolio and how you can continue to increase your passive income stream.
Yeah.
So first and foremost, let me see. Let's go. Okay, perfect. So what is Connect Invest and where did Connect Invest come from? Right, that's the first kind of question that comes up when people see us or hear about us. And so Connect Invest is truly just an online investment platform that's relatively new. So the owner and founder of Connect Invest started a company called Ignite Funding back in 1995, which is shown here. And Ignite was just your traditional mortgage lender. So they were funding houses and mortgages. But in 2011, they kind of reshaped and moved a different direction and became more of a lender for home builders and developers through what we call trust deed investments. So how that works is someone's looking for some sort of financing for their project. So they would go to Ignite looking for a loan to help them finish their project, acquire a building, whatnot. It would go through a process, and then they would have private investors essentially fund the loan, and they would get a return. So everything's, great and whatnot. And so with that, there's always some sort of feedback that you get. So people like the return. It is collateralized because there is a hard tangible asset behind the loan. But there was three common themes that came up. The first being people wanted more of a defined exit date for their investment. As you know, with real estate, you don't truly get that defined exit date. Most of the time, it's based on where you're lending the money and how long they need the funds for. I've seen loans go 3 weeks. I've seen loans go 12 months. I've seen them go 20. All throughout that, they're still paying the interest, so you're still getting the return. But depending on some people's investment goals and what they're looking to do, you might want that defined exit date. So that was one of the things that they, if they could, would change with the product. Secondly, is accessibility. What I mean by accessibility is traditionally in real estate, you either had to have been a high net worth individual or what we call an accredited investor. And so you had to meet certain specifications prior to even being introduced to a product. And then from there, most of the time, there is a higher investment minimum to even get involved, such as 50 to 100,000. And so a lot of people have made tremendous wealth in real estate investing, but it just has not been accessible to the everyday person or someone that can't front 50 to 100,000. So that was the second thing that kind of came up. And then the third was being, how do we minimize risk with real estate? Real estate is a very stable and non-volatile investment, especially with trust deed investing. And so if you have someone, or if you're someone that might have, let's say, $2 million to put across 20 different loans, we'd call that proper diversification. But not many people are fortunate enough to do so. And if your funds are invested, let's say, into one specific investment, and that loan goes into a default situation, because that does occur, your money's essentially locked up for that duration, and you may miss interest payments, but at the end, it'll get resolved and hopefully recover some of your accrued interest as well as your principal. But if you have 20 loans, that might not be as big of an impact. So with those three things in mind, the owner essentially said, how can we make a product that has produced great amount of wealth for people in the past and hit those three things? And with that in mind, Connect Invest was launched in 2020. And so Connect Invest in 2021 went to the SEC and got qualified for a Reg A offering. And what that Reg A offering allows us to do is touch all those key points, which we call short notes. So shown here, kind of touching on those things, is short notes allow you to get involved in investing into real estate without needing to meet all those qualifications. First and foremost, we have the investment minimum down to $500. Yes, that sounds kind of low, but what it allows you to do is to try the product at a minimum, dip your toes in the water. We're not looking for, 10 to 50,000 minimum to get involved. It's just that simple 500, because now it's making it more accessible so we can reach a greater audience for people looking to get that same consistent, stable return. Next, it's available to both accredited and non-accredited investors. This has been a huge step for us. It's been something that we've had tremendous feedback from our investors that weren't accredited, but now they're able to get into our short notes and get that same real estate investment type of deal. And then lastly, kind of touching on the risk aspect, when you invest into a note, you're not tying your funds to one specific product. You're investing against a diversified portfolio. So you're actually funding several different loans. And as a company, we are managing the funds and diversifying them on behalf of investors. And so we diversify it as much as possible to minimize the risk for the company and minimize the risk on behalf of our investors, the note holders. And just to kind of give you a visual, we're able to break it down into 3 specific series of notes. First, we have a 6-month note that pays 7.5%. We have a 12-month note that pays 8% and a 24-month note that pays 9%. All the interest rates are annualized, but you're able to select a specific defined date of when you're going to get your funds paid back. And then that interest rate as well is locked in. So that's what we were able to do with the short note program. And so to give you a little visual of how it actually flows is how we made it so relatively easy is right here at the top, you'll see this is number 1. These are just investors that are going through and purchasing short notes. So this is funded through individual investors. They go through, create an account, fund it, and then they purchase a note. So they have a note with Connect Invest that says, I bought a 6-month note at $500. Here's the interest rate. Here's my maturity date. We take the money and use those funds to invest into first position real estate loans. So they are collateralized and we are in first lien position. So it does minimize the risk in case of a default situation. So, and then from there, the borrower on those loans pays us interest, and then that's how the interest is paid back to our investors. And so this is just a very good visual to kind of explain that, you know, you are purchasing into real estate loans. It's just we're managing the money on behalf and making sure we're in correspondence with Ignite, collecting the interest and diversifying it to our or distributing it to our investors depending on their note itself. So to kind of touch on more of the benefits of the notes themselves, first and foremost, what I kind of hinted at is there are defined exit dates. So what you see is the date that you're going to get paid off. So if it's 6 months, 12 months, or 24 months from now, it's all outlined in your note purchase agreement. And it helps you align with your investment goals and know exactly when you're going to get paid back. Secondly, easy accessibility. There's kind of 2 things I like to talk about when I'm discussing accessibility. Accessibility is, you know, nowadays everyone's very busy with their lives. And the last thing you want is real estate investing to be a hindrance or taking more time than needed to still get the same stable return. What we did is we evolved with technology in the times and created a platform where you can create your account in a span of a few minutes, fund your account, and then once the funds are posted in your account, move forward and make an investment. And you could probably get that all done in about 4 to 5 minutes. Where traditionally, before the internet, you would have to get a series of loans sent to you, do your due diligence. Then when you decided what note or loan you wanted to go into, sign that series of loan docs, go and get the document notarized, and then go to the bank to wire the funds. And you know, if you're talking 2 to 3 a year, not too big of a deal. But let's say you start to talk 20, 30, it starts to become more of a hindrance, even though you enjoy the return, it's just now more time consuming than you'd like it to be. So that's all we've done is we've modernized real estate investing, still the same product, just a lot more easier to manage absolutely everything at the touch of your fingertips, kind of like a Schwab account, if you would, and do everything you want without even the need to talk to me or someone on our staff.
Cool.
Next, monthly passive income. So depending on the note you go into, you're going to get an interest return every single month paid to your account. At that time, you're able to withdraw the funds if you'd like, no fee, or you're able to reinvest those funds if you'd like to continue to compound. It just can't go into an outstanding note, unfortunately, just due to legal and compliance, but you are able to purchase a new note if you do have the $500 minimum. But again, a great way to get a passive monthly income stream. And then this kind of ties in when I'm talking about collateral back, this kind of ties into the risk because a lot of people have the question, what's the risk, right? The risk lies in the company and the loans we invest into. So we are always in first position. We are never in second position. What that means is if a borrower fails to make payment or defaults on the loan, we're able to file a foreclosure and take that property back to sell it to recover that loan balance. And I'll kind of get into loan to value, loan to cost in a few slides, but it's never funded at the full amount of the cost. It's always a fraction because we make the borrowers fund a portion to have some equity in the product. And so everything we do is in first position. So it does add some additional protection because there is a tangible hard asset behind the loan. And then second to last, fixed rates. So what rate you see is what rate you're going to get. It's not going to fluctuate on you throughout the duration of your investment. I think I just saw the I bonds drop about a point earlier this week, and you have, money market funds moving as well. With us, you're locked in at that specific rate. That's the return you're going to get throughout the duration of your investment, either if it's 6, 12, or 24 months. And then lastly, diversified portfolio. So we have tried to diversify as much as possible as you can in the real estate world. What I mean by that is we're involved in commercial loans, we're involved in residential loans. And in those two sectors, we're involved in different project types, such as acquisition, development, and construction. What acquisition means is going out and acquiring a raw piece of land or an existing building. Development is putting in sewer, gas, electric utilities, grading the land, getting it ready to go vertical, and then construction as well. And then we're also diversified across right now 14 states, 40 cities, and over about 30 different borrowers. So we're not in one specific geographical location. We're not just in commercial. We're not just in residential. We have diversified those funds to, again, minimize the risk for our investors to continue to produce a great return. And it will kind of show here with what we've done. And this is at the end of March, actually. Through the short notes program, we funded about 105 loans. And since then, 51 of them are active and in good standing, so they're still paying interest. And we have had 51 successfully pay off. One of those was actually in default, recovered, no loss principal, accrued interest for Connect Invest. And then there are 3 in default. Those have positive resolutions, to be completely honest, where 2 are supposed to be resolved relatively soon, and then the one's up for market. But this has not any effect to our investors because this is on the company to get resolved. So there hasn't been any missed interest payments to our investors or any principal payments. But again, nothing's ever going to be perfect, so we're just always very transparent with what's going on in our portfolio. So for the diversification side of things, 24.6% of our projects have been in the construction side, 25.4% has been in development, and 50% has been in the acquisition phase. Acquisition is relatively higher because when you start going into development and construction, traditional lending sources such as banks typically will start to lend on those. It's just raw land they're not a huge fan of because it's small banks don't have enough capital to touch and large banks don't want it because it's not income producing. But we view it with the value of the land. It's still a great investment. It's proven to be tremendous. So to give you just a general visualization of kind of where our projects are. So we're located in Nevada. And so a lot of our projects are on the western side of the states. And one of the reasons for that is the underwriter of Ignite visits the projects once a month to ensure that they're on pace. There's nothing that came up to ensure that they are going to pay off and everything's coming to fruition. Every once in a while, we do have some loans that we do over here on the East Coast, but that's only due to a borrower that we have a pre-existing relationship with that's been very beneficial that maybe found a project such as a commercial mall in Illinois or a single family in North Carolina that they want to do. At those times, they'll lend to those. But again, mainly just sticking on the West Coast, what we see, what we know. This is in our realm or our wheelhouse. So yeah, just a good visual, but 40 cities, 14 different states. So now you're probably wondering who Ignite funding is. And so Ignite funding, as I mentioned in the first slide, was introduced in 2011 to lend money to developers and home builders. And so they've done about $1.9 billion in loans. So yes, Connect Invest is relatively new, but the product we invest into has a proven track record and has been around for over a decade. Just with Connect Invest, you're getting greater diversification, you're getting a fixed exit date, and you're getting greater accessibility. And so out of the 1.9 billion loans they funded, they've done about 1,300 of those, and they have relationships with about 100 plus borrowers. So this loan to value, loan to cost shown here, their average is about 64.84, which holds true to our short note portfolio. The reason this is critical, and I like to go into detail on this specific number, is because this is what they're lending funds out to borrowers depending on the cost of the project. So essentially every dollar the borrower spends, we fund about 65% of that. Or another way to look at it, if a project is worth $1 million to buy, or a piece of land is worth $1 million to buy, and it gets underwritten and going to be serviced, they'll fund 650,000 at 65% loan to cost, and the borrower funds remaining 350. So what that allows us to do is if they default, we're able to take back that property that we know is valued at $1 million, but we only have a loan on it for 650. I kind of compare it to a house situation. If you have a house, let's say, and you got 20 or 30% equity in the home, and all of a sudden you find yourself in a situation where you can't make payment, majority of the time, if you know the value of the house is still there, you're not going to just walk out the front door and say, yep, bank, take it, I'm done. You're going to try to sell it to pay off the loan and at least recover 10 to 15% of your equity, if not, hopefully more, because you know the value's still there. And so that's very similar with our borrowers and the loans we do. And that's why loan to cost and loan to value is so critical with the loans that we are help funding and adding to our portfolio. And then lastly, their average loan duration is about 9.91 months. So the loans are underwritten in 9-month terms. So they're constantly current with current market conditions. And then the diversification of their entire portfolio, 19.6% is in construction, 27.7% is in development, and 52.7% is in acquisition. So it's very similar to what we have funded in the short note side of things. So it just proves that it has held true from 2011 to the end of last year. So now, one of the last things I'll talk about Ignite is just their proven strategy for underwriting these loans. And so the last couple of years, there's been a lot of fluctuation with interest rates and what's been going on in the economy. It's been all over. And you're starting to see mortgage rates increase. You're starting to see lending prices increase, especially hard money lenders are starting to increase to, 13, 14, 15%. And I bet a lot of investors call me up and say, hey, Mason, I'm curious, are you guys fluctuating the rates or what's going on? We're seeing, traditional lending's now starting to get close to what Ignite's lending at. Other hard money lenders are at 14 to 15. Where are you guys at? Do you think you're going to increase defaults? What's going on? So I sat down with the director of underwriting with Ignite and I said, I'm getting a lot of questions on this. Can you help me explain it in better terms? I have an understanding, but what can I explain to our investors? And he said, the last decade, we have held rates at 12 to 13%. We have not fluctuated. And sometimes we're cheaper than other lending sources and sometimes we're more expensive. But in times like this, the reason we haven't increased our rates is because now that we're cheaper, we're starting to see an increase in applications for borrowers for funding. What that allows them to do is be more selective on the loans they're underwriting and servicing and releasing to investors, as well as loans we're adding to our short note portfolio. So continuously adding good quality paper and loans to our portfolio. And again, from there, they have a high borrower retention rate. So once a borrower uses Ignite, Ignite's not your typical one and done sort of lender. They don't broker anything out. Once a borrower uses Ignite at some point, they will typically use them at some point in the future, even if they might be a little more expensive because of how fast they're able to fund loans, their customer service, and their track record. So what we've seen is Ignite's just constantly strengthening their underwriting, and it's allowing us to add great quality paper continuously to our portfolio. And so this is the last thing I'll point on this slide because I think it's very insane actually. In the last 5 years, out of the 1.19 billion they funded, they've had a loss of principal of 0.25%. I believe the industry standards anywhere from 2 to 4. I know one of our competitors is at 2% loss of principal, but that just proves that their underwriting strategy, the borrowers that are coming to them that they're lending on, and the loans and the properties that we're funding are very quality, and it's not many situations where there's a loss. And that's obviously past performance. It's not going to guarantee future results, but we believe it's a good indicator with how we have our portfolio set up, where we actually carry twice that amount on our balance sheet as a credit loss allowance per an SEC and audit guideline. So just something to keep in mind there.
Cool.
And so last few slides, how to get started. It's relatively easy. You just go to connectinvest.com to start your account. We do have a special landing page with Tardus that you're able to go through and sign up. And if you sign up and create an account and either use their landing page or notate in the source how you found us through Tardus, we are doing a promotion in the next 40 days. If If you fund that account, make an investment, you will get a $50 credit to your wallet just as a promotion that we're doing with them. And so with us, you're able to do an individual account, business account, self-directed IRA, or trust. And so you start the account, you verify your identity. We have to do an identity verification check because it's a compliance sort of thing. So we have to verify against the database. And then you fund your account. And then once your funds are in your account, you're able to go through and you'll see the 6, 12, or 24. It'll outline activation date, maturity date, and the rate. So you'll go through, select your note, sign the subscription agreement, and then from there, when you confirm, you'll actually get the note purchase agreement emailed to you as well. And then lastly, you are able to track everything through your account dashboard. So from there, you'll see your active investments. You could transfer funds in and out through your wallet via ACH from your account connected, view your transaction log, and do absolutely everything through your dashboard in that sense. So appreciate you guys for taking the time out.